Breaking news, the US economy has officially shrunk. But wait, is this just a blip? Or the first domino in a looming recession? Inflation is up, job growth is slowing, and consumer confidence is tanking. But is America really heading for a recession? Or is the media just creating panic? Today, we break down the numbers, what they really mean, and why this matters to you. Is the system breaking down? Or is this just the calm before the storm? Stay with me till the end, because the truth may shock you. Let's start with the biggest headline. In the first quarter of 2025, the US economy contracted by 0.3%, the first decline since 2022. This downturn was unexpected. Analysts had predicted growth of 0.3%, but instead, the economy shrank, resulting in a 0.6% gap between expectations and reality. Why did this happen? The drop wasn't random. Imports surged by 41%, the fastest increase since 2020, as businesses rushed to stockpile goods ahead of possible tariffs. And remember, imports subtract from GDP. At the same time, government spending declined, removing a major growth driver. These two forces dragged GDP deep into the red. Yes, investment, consumer spending, and exports rose, but they weren't enough to offset the massive surge in imports and the government pullback. Interestingly, while spending held up in the first quarter, consumer confidence dropped sharply in April, suggesting Americans are bracing for impact. Imagine a massive train gaining speed and suddenly hitting the brakes. That's what this economic drop feels like. If this trend continues into the next quarter, we'd officially be in a technical recession, defined by 2 consecutive quarters of negative GDP growth. And if you think this doesn't affect you, think again. Shrinking GDP means slower business, fewer jobs, lower wages, and tighter credit. From small businesses to your family budget, this ripple spreads fast. Now let's talk about something you're already feeling: inflation. The PCE price index, the Fed's preferred inflation gauge, jumped to 3.6% in March. To compare, February's number was 2.4%. Economists had expected 3.1%. Instead, prices surged past forecasts. Here's what that means for you. If you spent $100 on groceries last year, you're now spending $103.60 for the same basket. Multiply that across every monthly expense, and you feel the squeeze. But here's the kicker. This surge puts the Federal Reserve in a dilemma: raise interest rates to fight inflation? That could slow the economy further. Cut rates to support growth? That risks an inflation spiral. It's a tightrope walk, and one misstep could push the economy deeper into danger. But rising prices aren't the only concern. What happens when jobs slow down too? In April, the US added just 62,000 new jobs. Sounds okay? Not when you realize economists expected over 200,000. This marks the lowest job growth since July 2024. Leisure and hospitality led with 27,000 new roles, but those are largely seasonal and part-time. Meanwhile, finance, manufacturing, and construction are showing signs of real weakness. So what does that mean? It means businesses are scaling back hiring, a move often made when companies expect tougher times ahead. And if hiring slows, layoffs could follow. And when people stop feeling secure about work, they stop spending. That brings us to another critical warning sign: consumer confidence. In April, the Consumer Confidence Index fell by 7.9 points to 86.0, the lowest reading since May 2020, according to Reuters. Even worse, the Expectations Index, which gauges how Americans feel about the next 6 months, dropped 12.5 points to just 54.4. That's not only the lowest level since October 2011, but it's also far below the recession warning threshold of 80, as reported by the Conference Board. Why does this matter? Because confidence drives spending. When people are optimistic, they buy, invest, expand. But when they're afraid, they save, pull back, and hunker down. And right now, America is pulling back. So how are the experts reading these signals? Let's look at what Wall Street and economists are predicting. Wall Street is watching, and they're not optimistic. Goldman Sachs now puts the chance of a US recession at 74%, according to AP News. That means markets are already pricing in a downturn. And while it takes 2 quarters of GDP decline for an official recession declaration, these economic red flags are triggering every model on Wall Street. But before we panic, let's pause. 1 quarter of GDP shrinkage doesn't make a recession. Or does it? Technically yes, we need 2 consecutive quarters of negative GDP, but when you combine 1, a surprise GDP contraction, 2, surging inflation, 3, slowing job growth, and 4, collapsing consumer confidence, you get a picture that's hard to ignore. Add to that rising tariffs, a widening trade deficit, and global instability, and you've got a system that could tip over at any moment. Meanwhile, the Federal Reserve is at a critical crossroads: raise interest rates further and risk choking off growth, cut rates and risk fueling even faster inflation. And with geopolitical tensions rising and global trade slowing, the Fed has no easy way out. Whatever they do next could define the rest of 2025. But here's what matters most. How can you stay safe in uncertain times? Here are 4 smart steps you can take right now. 1. Tighten your budget. 2. Limit unnecessary expenses. 3. Build an emergency fund. And 4. Avoid risky debt. Because whether we call it a recession or not, economic storm clouds are forming. And those who prepare now will ride out the storm much better than those who don't. We've seen the signs, we've connected the dots, but the big question still remains: how bad could this get? In our next video, we'll explore the possible economic scenarios for 2025 and what you can do to not just survive, but thrive. So hit like, subscribe, and turn on notifications because you won't want to miss what's coming next.